of you I haven't met before, my name is Rebecca Riley. I'm Director of the Economic Statistics Centre of Excellence and delighted that you've made the time to join us for our annual conference on economic measurement. So we have much to look forward to over the next few days. Looking through the conference programme, it's difficult not to be struck by the range of the impact that research on economic measurement and economic statistics is having now on our understanding of the economy and society today. The research that will be discussed over the next few days includes many examples of the creative use of novel and complex data sources to address key and topical economic issues. To take one topical example, uncovering patterns of adoption of artificial intelligence throughout the economy, measuring the exposure of jobs in particular occupations to automation, and how technical change might affect different workers. And another example, mapping production networks to such a degree that we might begin to see the way that purchases of particular goods and services feed through value chains, where these purchases come from, their environmental impact, and how supply chain disruption might affect activity in particular industries or local areas or groups of people. Maybe even all of this in something approximating real time. And the list of examples goes on. The research and discussions at the conference will raise many questions and will begin to develop some answers about how we should conceptualize and measure the contributions to GDP, health, wealth, and well-being of the significant part of our economy that occurs outside the market. And this is a topic of discussion during several sessions this afternoon and also on Friday. The relationships between the environment and the economy considered during several sessions tomorrow afternoon. And not least, a topic for discussion throughout this conference, how we should conceptualize and measure that which has been lacking, productivity growth. And the proceedings over the next few days will without doubt illustrate the gains in understanding of our economy and society that can be had from the development of economic measurement through research partnerships between academics and producers and users of economic statistics, which is what the Economic Statistics Centre of Excellence, ESCoE, is all about. So, thank you for submitting your papers, and thank you to the scientific chairs, Bart Loos, Mary Omani, and Arthur Turrell, for curating such an exciting program, and to Sarah Shepherd and Caroline Lewis and their teams for organizing everything and all of us. And thank you to the Office for National Statistics, the ONS, not just for supporting this conference, but for awarding a further 5 years of core funding in support of the work of the ESCoE, for taking the lead in the UK, but also for leading by example internationally in fostering open and productive dialogue between statistical agencies and the academic community, and in galvanizing research towards the development of economic measurement and economic statistics. So it's an exciting time ahead as we embark on a new research program at the ESCoE here at King's College London, focusing on beyond GDP, net zero, productivity and innovation, national accounts, and much more. And we are soon to be joined by a new cohort of PhD students and other early career researchers to take this agenda forward with ESCoE colleagues across the UK and internationally. Particular thanks to ESCoE colleagues who have joined us this week from abroad, be that from Australia, Austria, France, the Netherlands, the United States, or elsewhere, for traveling to come to this conference, for lending your expertise to driving progress on these issues, and for helping to create such a productive environment for measurement research. Before we get started, and I hand over to my colleague, Professor Paul Mizen, Deputy Director of ESCoE, to chair our first keynote, there are a few practical announcements I have to make. Importantly, there are no expected fire drills taking place during the conference. Any fire announcements should be taken seriously. Please note that some of the sessions here in the main auditorium are being live streamed on Zoom, and there will be a photographer taking pictures throughout the conference. Also, the conference organizing team will be on site throughout the next few days. You can recognize them from their greenish bluish ESCoE t-shirts, and they are happy to help if you have any questions. And please make sure to enjoy the conference. Thank you.
Well, thanks for that introduction, Rebecca. It's now my great pleasure to introduce David Miles, our first keynote speaker at this ESCoE conference. Now, I'm sure many of you know David. David's an academic economist based at Imperial College London, a member of the Commission of the Irish Central Bank and the Office for Budget Responsibility. His talk today is going to focus on his long-term interests in understanding the housing market, house prices, and mortgage finance. So let me briefly mention a few of those and how important they are for the UK. Back in 2003, David wrote a report for the Chancellor of the Exchequer on the long-term fixed-rate mortgage market in the UK. Unlike the US and many European countries where long-term fixes are common, they are less so in the UK. David's report shed light on the short-term focus of UK borrowers, often to their detriment. 20 years on, after at least a decade of low interest rates, it remains a puzzle why Britons don't fix their rates for longer, as citizens of many other countries do. Low rates were brought in after the financial crisis, and David was pivotal there as a member of the Monetary Policy Committee of the Bank of England. Overnight interest rates were reduced to near zero, and central banks, including the Bank of England, explored ways to stimulate the economy with purchases of government bonds, often known as QE. These policy decisions lowered the nominal long-term rate of interest, encouraging businesses to refinance their existing debt and lowering the cost of mortgages for house purchase. However, negative real rates of interest also increased house price to income ratios. And this underlines a very interesting issue about the general equilibrium effects of rate changes, which many policymakers should pay attention to, and I'm sure David will be talking about in a moment. But there are other relevant factors to house prices and housing markets that David is going to consider as well. David, over his career, has paid a lot of attention to demography, and particularly to longer life expectancy. I think we all agree that living longer is a positive thing, but it has some economic effects that need to be taken into account. And exactly how demographics and the related concept of population density drives long-term house prices and the optimal structure of house finance is a question to address. And then there's also a number of changes that have happened recently that David has paid attention to. So, for example, just before COVID, David wrote a paper on transport improvements and the relationship with the future path of house prices, and showed that these had been very closely connected for 150 years in both the UK and the US. Steady improvements in transport led to lower house prices, but as the pace of transport improvements, measured by the average speed of commuting, have stalled in recent decades, so house prices have increased. Now, with the onset of COVID and the phenomenon of working from home, we might ask, is that relationship still holding? And will house prices still continue to rise? Maybe David will tell us something about that. So let me hand over now to allow David to speak about these, drawing on his areas of expertise. I'm sure it's going to be a very illuminating talk. Thank you, David. There'll be questions afterwards, and we'll be happy to take those when we come to the front after David's talk. David.
First challenge is to find my slides. Let's see if I can do that. Where might they be? Interesting question. The mouse seems to have given up on life. Oh, right, there we go. Hold on, maybe it's under that. Maybe I can find them there. Oh, there we go. Well. Hooray. Always a relief, that terrible moment. Thank you very much, Paul, for those kind words. I'm going to offer some thoughts looking both backwards and forwards about housing markets in the UK, but I'll do a little bit of international comparison as well. And I think much of what I say will fall into the category of speculation rather than hard science. But I think speculation is a good thing. One of the nice things about talking about housing is you don't really need to have to persuade an audience that housing is interesting and significant. Both at an individual level, I think we all recognize that, but its significance in a macroeconomic sense is also pretty self-evident, just in terms of the size of the capital stock that's represented by residential property, its significance in individual budgets and so on. So one doesn't need to spend 3 or 4 minutes at the beginning of any kind of talk saying, here's why housing might be of some significance. I have a colleague at Imperial whose research, as far as I can make out in recent years, has been largely about the sex life of badgers. And she does need to spend some time explaining why this is of interest. Actually, I've learned from her 2 things about the sex life of badgers, which I will share with you. This is a digression. The first is, apparently, it would appear as if badgers are monogamous, which I think is probably somewhat unusual in the animal kingdom. But the other thing that's interesting about badgers is that when they have sexual intercourse, it seems to be very relaxed and lengthy. So they're unusual animals. That's the 2 things I know about the sex life of badgers. But it makes I want to learn more about this. But it wouldn't be my comparative advantage if I have one. So I'm going to look a bit back over the last 40-odd years of housing markets in the UK and indeed in some other countries. Talk a little bit about why something that in many ways is extraordinarily unusual, namely the increase in the relative price of houses relative to almost anything else, why did that happen? And I think that is a helpful precursor to the more speculative forward-looking bit of what I'm going to talk about, which is what might the next 40 years look like? And might we get more of the same? And if we did, then houses would become ever more expensive, not just relative to other things, but relative to people's incomes? Or might the next 40 years in the UK actually look very different? And I'll offer a few thoughts on that, focusing really on 3 things, which I think are pretty fundamental to driving housing valuations. One is interest rates, and I think that's at the centre of an understanding of the last 40 years. The second is demographics, which I think will likely be rather different in the UK and indeed in many countries, particularly richer countries, in Europe in particular, will be very different over the next 40 years than it has been over the last several decades. And finally, I'm going to offer some thoughts about something that's happened really rather recently, which we're all familiar with, which is the unusual effectiveness of people being able to work from home and how that might change the demand for different kinds of houses and location choices that individuals make, and offer a few thoughts based on some very recent work I've been doing with a colleague of mine at Imperial, not the Badger lady, but James Sefton. So, first of all, let's just look backwards a bit. This is a measure of the average price of houses in the G7 countries, deflated by consumer prices pretty much over the last 40 years. The data go up to about the beginning of 2019, so it's kind of pre-COVID. I don't think the picture would change very much if you use the very latest data, because what it would reveal is something which we're pretty familiar with, I suspect, namely that not only have real house prices in the UK, so it's house prices relative to all the other things that enter into the consumer price index. And not only have they risen very dramatically over this period, a 3.5-fold increase in about 40 years in the UK, but that they have risen faster than in any other of the G7 countries. And in some of those G7 countries, house prices, I think it's Germany and Japan there, you start out at an index of 100, you end up at an index of 100. It doesn't change very much from 100 along the way. In other words, house prices have kind of pretty much followed the same trajectory as consumer prices in general, and that is spectacularly not the case in the UK. And I mentioned that house prices, as we all, I think, are very familiar with, have risen not just relative to the price of other things that people buy, but relative to people's income. So the panel on the top right there is a measure of average house prices in the UK relative to an index of disposable income, and whether you measure house prices relative to average individual earnings or average household earnings, the picture is pretty similar, which is that they have gone up enormously, pretty much double. The time period runs from, the early 1980s up to a couple of years ago. And you can see that house prices have, certainly relative to individual earnings, meaningfully more than doubled. Which is, we've kind of got used to that has happened. We all kind of know that something like this has happened. Although when you think about it, to have the price of something so significant in people's lives rise twice as fast as people's incomes over such a period is pretty extraordinary. And also unusual relative to all those other G7 countries we looked at data on a moment ago. It's also the case that house prices have gone up on average anyway, over this period, rather significantly faster than rents. And one of the things one would want to try and understand is both why house prices have risen so much relative to other goods, relative to people's incomes, but why rents have not increased as much. And I think I'm going to describe a little bit of work I did with a colleague at the Bank of England, Victoria Monroe, which argues that the very substantial decline in real interest rates is really the answer to both why house prices have gone up so much relative to incomes, and also why house prices have gone up, at least on average, more than have rents. And so the rental yield, which you would expect in some intuitive sense to be linked to the rate of return on alternative investments you could make, has declined. I'm then going to talk a little bit about demographics and work from home, which are the lead into my final speculative thoughts about what does the next 40 years look like, and does it look like the last 40 years or something really rather substantially different. Let me talk about real interest rates. Many of you will be familiar with the story about real interest rates in the UK. And by real interest rates, what I mean is the yield on inflation-proof index-linked bonds, which is really a very clean measure of this, what you might call the safe real return that people require on their savings. And that's the picture. If you go back to the early years when the index-linked bonds in the UK were first issued in the kind of early-ish toward the mid-1980s, the yields on those bonds, whether you were looking at 5 or 10 or 15 or 20-year maturity index-linked gilts, was around about 4% or so. By the mid-1990s, that was perhaps a little bit nearer 3%. At the end of the last century, it was, more like 2%. Around about the time of the financial crisis, but before the financial crisis, yields were down to about 1%. And until very recently, they've continued to head south. So that if you go back a few years to, say, a year or two ago, you're looking at yields which were about minus 2.5% real. So that is an enormous change in a real interest rate over a sort of less than 40-year period, from +4 to about -2 and a bit. And in some ways, it's not very surprising when you think about the fundamental value of a house, that a change in real interest rates of this magnitude should have had a very dramatic impact on valuation. A house, of course, is a long-lived asset. you could think one way about thinking about the value of a house is it's the present discounted value of the flow of services you get from ownership and perhaps occupation also of that house over a sustained period being relevant given the longevity of most houses. With a little bit of repairs along the way, they last a long time. And in some sense, a house is then analogous in terms of valuation to another long-lived asset, which is a claim on a corporate flow of income, an equity. And we think of standard, introductory economic idea. What's an equity? What's a share in a company worth? It's the present discounted value of the flow of earnings that are generated by ownership of the share, the dividends. And you could think of the valuation of a house in the same fundamental sense as being the present discounted value of the value of occupying that house, which could be proxied by a kind of what's the imputed rent that people get from living in a house. Not just imputed, but if you're a landlord, it's the actual rent, and it's the present discounted value of that, discounted over a long time horizon. And when long-term real interest rates decline by this sort of magnitude, then unless there's some dramatic offsetting negative effect upon, for equities, the flow of dividends, or for houses, the imputed rental value of owning the house, unless there's some offsetting hugely negative effect of that, then you'd expect the valuation to increase very dramatically. And in a sense, that was what the piece of research I'm going to very briefly outline tried to do. Taking account of some complexities, of course, the expected rate of return on equities, the expected rate of return people desire on housing, isn't really the same as, of course, the required rate of return on an asset as safe as an index-linked bond. They have very different risk characteristics. So we need to think a little bit about how discount rates that you might apply to housing and also to equities might need some rather substantial adjustment over and above just looking at what you might call the safe real return on a bond issued by the UK government, which has virtually a negligible chance of default and is guaranteed to be uplifted in line with a consumer price index. And so there's a few complexities one would want to add in before just concluding, well, that's the story as to why house prices rose by so much relative to other goods and relative to people's incomes. But it'll turn out that actually allowing for all those other complexities doesn't really diminish the force of the story, which is that had not there been such a significant decline in real, safe at least, interest rates, house prices probably wouldn't have risen very substantially relative to people's incomes. Let me just say, just very quickly, some of the sort of complexities that I tried to allow for in the piece of research with Victoria Munro. It's published in the journal Economic Policy a couple of years ago. You could find it on my website if you have an interest. The driving idea behind the valuation story, the model of valuation, is that there's kind of likely to be an equilibrium condition in the housing market, which looks a bit like this slightly messy equation, but the intuition, I think, is relatively straightforward. So think of what you might call the cost of owning property for a period, for a year. And it's the interest rate that you might have to pay on any debt that you have to finance the purchase of the property. Or if you didn't use debt, but you used your own other assets, it's the opportunity cost of not having money to invest in bonds and equities and other assets. So part of the cost of home ownership is either that you've got to pay interest on a mortgage or that you don't get any return on assets you would otherwise have held if you hadn't bought the house. So the term on the left-hand side, that UCH is the user cost of housing at time t, that's going to depend on interest rates. So that first term in brackets, so we've got the price of a house, it's a £100,000 house. You either have to pay the mortgage interest rate or you forego interest that you could have earned on assets. That's the first term in the square brackets that gets multiplied by the price at which you bought the house. And remember, what we're trying to do is work out what's the cost to you for 1 year of owning that property. So I'm going to measure everything in real terms. So we need some measure of the risk-free real interest rate, and we need to add on a risk premium. You can think of that risk premium as how much more is the interest rate on a mortgage in real terms than what people need to get from an index-linked bond. So that's one way of thinking about it. Or you could think of, for that part of the financing of a house that is foregone investment in other assets, what is the risk premium you would need given the risk characteristics of, in a sense, investing in housing relative to a safe asset? So that final term in square brackets, that's a risk premium term. And we've got some other costs as well of owning a house. Firstly, you need to look after it and it will depreciate. And there's some maintenance costs, that's the second term. There's some taxes you have to pay, some of which you have to pay just because you're occupying the house. Some of them you pay only if you own the house. There's an offset to some of those costs from the potential capital gain you may enjoy from home ownership. And that final term then is that risk premium, which is the difference between a safe real rate and, in a sense, the discount rate on an asset that is not as safe as an index-linked bond, which is housing. So that's a kind of fairly comprehensive measure of the resources you have to give up in order to enjoy the use of a property for, let's say, a year. And that, in equilibrium, should equal the valuation of being able to enjoy living in that house, apartment for a year. And you could think of that as the rent you would have to pay to live in a house that you didn't own but you were just renting. So that's the RR term on the right-hand side. So if that's an equilibrium condition in the market, and you rearrange the equation slightly, you get something which is sort of similar to equations that people use to value equities. What is that equation? And what it says is that, rearranging that first bit, the rent that you would have to pay to enjoy the services of a house if you went out into the market and rented it, so that's the RR bit, and then it's kind of divided by a discount rate, which is a safe rate plus a bit of stuff about depreciation, minus an expected capital gain, and plus a risk premium over and above the return on a safe asset, which we take to be an index-linked gilt. And if we, I said that was equity, you could think of that as, well, what's the earnings on an equity? It's the sort of corporate earnings available to the shareholders divided by some required rate of return, which is a bit like saying that the valuation is equal to the present discounted value of the future flow, discounted at some rate. And once you set up that, a kind of simple calculation immediately reveals something that, in a sense, is kind of intuitively obvious, which is that, holding everything else constant, if there's a fairly substantial decline in a real rate of interest, the impact of that on house prices is likely to be very large. Simple calculation, suppose you started out in a position where the risk-free rate was plus 2%, probably about where it was in the, again, taking index-linked bond deals in the UK, maybe around about late 1990s. Suppose you took the risk premium, which again you could think of as, how much higher are mortgage rates than the rate that you get on gilts. I'm putting that at 3% just for illustration, really. Depreciation, how much does it cost you to repair the house during the course of a year? I'll put that at 1%. there's some taxes, and there's an expected capital gain. And let's just suppose that the numbers are as I illustrate on the chart, then the house price relative to the rent would be, the house price would be about rent divided by 0.05. 0.05 is just the sum then of R plus delta plus the other terms in the equation at the top. So in other words, house prices would be about 20 times the annual rent on a comparable property. Suppose then that the risk-free real rate falls to zero, pretty much what it did between mid-1990s and leading up to the financial crisis, 2007, 2008, pretty much did go from +2 to about 0, and nothing else changes. What would we find? We'd find that the price of a house would have gone from being 20 times annual rent to about 33 times annual rent. Rental yields would have come down. Again, not surprising. The alternative rate of return to somebody who could be a landlord or they could own a bunch of bonds has come down. Therefore, the equilibrium rental yield that reigns in the market would be lower. But more interesting, what it does to house prices, which go from being 20 times annual rent to 33 times annual rent. So that's a 67% increase in real house prices, holding everything else constant. When I say holding everything else constant, I'm holding constant in this simple calculation, well, but wouldn't the supply of housing go up if houses were worth so much more? And if you had a very elastic supply of housing, wouldn't that offset some of this price increase? To which the answer is yes, it would. And I'll show you a couple of calculations which use kind of plausible ballpark figures for the elasticity of the supply of housing in the UK to higher house prices, which is a low number. And you wouldn't get as big an increase as 67. On the other hand, 67 is what you get from a 2% decline in real interest rates. Remember, taking again the index-linked bond yield, we go from +4 to -2 and a bit. So that's 600 basis points, not 200 basis points decline in safe real rates. That would only happen, of course, if that decline in real interest rates was unanticipated. If everybody knew back in the mid-1980s that over the next 30, 40 years, real interest rates would fall by 600 basis points, it would have, to a very large extent, already have been reflected in house prices right at the beginning. But actually, nobody knew that. And we kind of know that nobody knew that because you can kind of work out from the shape of the yield curve at different points in history in the UK what the implied future path of real interest rates would be. If you know in 1985 what the yield curve looks like, and we do, Bank of England, wonderful data set available on their website, real yields, estimates of real yields going back to the mid-1980s up until yesterday evening. So you can work out from what the yield curve looked like at a point in time, in a sense, what the market was anticipating real yields would be a month ahead, 5 years ahead, 10 years ahead. So the right-hand chart here shows, for much of this period, both what the 10-year real index-linked bond yield was at each point in time, and also an estimate based on bond prices at each point in time, what the implicit market anticipation was of what the 10-year yield would be 10 years ahead. So it's the forward rate. If people had seen what was coming, and they just knew that 10-year yields were just going to fall very substantially over the next 10 years, you would expect that the implied future 10-year yield, that's the sort of purpley line, would consistently be well under the actual current 10-year yield, but it isn't. In fact, they're pretty much, they wobble about relative to each other a bit, but they're pretty much in the same place. In other words, I think a fair description of what happened in the UK over this 40-year period is that every time the yield on index-linked bonds moved down a bit, people were kind of rather surprised by it and thought, well, that's as low as it's going to go. So when it was 4, they thought it's going to stay at 4. When it was 3, it's going to stay at 3. When it was 2, people said, wow, it's gone down a lot. It can't go down any further. Surely, what's our best guess for where the yield will be 10, 15 years from now? It'll be at 2. It's not going to be any lower than that. And then it goes to 1, then 0, then minus. So I think it's fair to say that this huge decline in real interest rates, that's the left-hand chart, you've seen it earlier anyway, was both extraordinarily large and consistently came as a surprise, was not anticipated. And the few simple calculations I'm now going to show you try to sort of pull out from that how much of an increase in house prices, real house prices, might have been due to just that factor in isolation from other things. First of all, I'm going to show you some simple calculations. This is the same equation again. Some simple calculations based on no supply response. So there's a big fall in real interest rates at a particular year. People didn't see it coming. Imagine that there's no supply response. It's not a bad assumption, actually, for the UK, relatively low elasticity of supply. And over the whole period, mid-80s to just before the pandemic, the bottom line is that if you take the actual decline in those safe real interest rates in the UK, that might have added something about 125% to house prices. In other words, it would have more than accounted for the doubling in house prices relative to people's real income. Things are, that overestimates the actual plausible effect of real interest rates because there was some supply response. So in the paper we put in a sort of low but plausible estimate of the supply elasticity of housing, and that number, 125%, i.e. more than a doubling in real house prices just because real interest rates were lower, comes down to pretty much 100%, i.e. a doubling, when you allow for a bit of an elasticity of supply. Of course, house prices went up by more than doubling. They went up because we've also got other stuff going on. In the paper we try and take account of rises in people's incomes and some offsetting impacts of some tax changes. But the story here then is that if you want to understand why house prices went up so much in the UK, real interest rates are really right at the centre of this story and probably the single most important factor. It generates a question, of course, which is, well, why didn't this happen in other countries? Is there something unusual about the decline in real interest rates in the UK? Well, in some ways there is. It is true that measures of real interest rates, for example, based on inflation-proof bonds in the US, they've been issued in European countries as well. France has issued significant amounts of these bonds. There were substantial declines in real interest rates measured by inflation-proof bond yields in other countries as well, but they seem to be somewhat larger in the UK than in those other countries, and it's also true that the supply elasticity of housing in the UK does look unusually low. So I think it's a combination, when it comes to explaining why the increase in house prices in the UK was so much more than in other countries, it's partly the fall in real interest rates seems to have been bigger, and it's partly the supply response seems to have been weaker. But real interest rate movements seem to be at the heart of that. That's kind of slightly backward looking, trying to understand what have been the big factors over the last 40 years. I want to spend the remaining 15 minutes or so thinking about what might come next and talk first a little bit more about interest rates and why they either might follow the same trajectory as the past, i.e. stay low, maybe even becoming more negative again. I want to think a little bit about demographics and offer some particularly speculative thoughts on work from home. all leading to a tentative conclusion about why the next 40 years may not look like the past 40 years. So first of all, just a few thoughts about real interest rates. And I find it kind of hard to believe that the path from here on forward can follow the trend of the past 40 years, where we've gone from, +4 to -2 a couple of years ago. There's been an increase more recently. Right now, index-linked bond yields, the 10-year index-linked bond yields in the UK is just about positive, having been -2 and a bit. So we've seen some movement back up already. I think there are reasons to believe that from where we start right now, if anything, a slight increase in real interest rates might be more plausible than a further decline in the UK. One is just the size of the increase in government debt, not unique in any ways to the UK, but very substantial nonetheless. Before the global financial crisis, the stock of debt to GDP in the UK was a little bit less than 40%. It went up to about 80%, largely as a result of the financial crisis, and then a combination of COVID and the Russian invasion of Ukraine and the knock-on effects on inflation in the UK and the government's response to increases in energy prices. A combination of those things has taken the debt-GDP ratio in the UK to about 100%. Hard to believe that that has no effect on the required yield on the stock of government debt, not just in the UK, but more internationally. Second factor, which is a specific UK factor, which makes me inclined to the view that real interest rates are pretty unlikely to do what they've done over the last 40 years, which is follow a general downward trajectory, is that one of the biggest buyers of index-linked bonds in particular, government bonds more generally in the UK, has been defined benefit pension schemes, which are now largely closed to new inflows of funds. They're not open to the membership. University pension schemes, one of the few that's still open. And even that actually is kind of not quite fully open, not as open as it used to be. And so defined benefit pension schemes, which have been major buyers of government bonds because they hedge the liabilities probably better than most other things, and particularly index-linked bonds, given the nature of the liability of a DB pension scheme, which has, to a large extent, inflation-indexed liabilities, long duration. Buying longer-dated index-linked bonds is a kind of natural way of hedging much of that risk, but the stock of liabilities is likely to gradually come down over the next 40 years. With very few schemes open, and with all those who've got accumulated rights to pensions getting older and older, then the remaining stock of liabilities is likely to shrink, and shrink very substantially. Again, hard to believe that that won't have some effect on the required yield on index-linked bonds in the UK, given how significant the demand has been from pension funds for such bonds. And I think more generally across the world, one of the likely causes of falling real interest rates over the last 30, 40 years globally, not just in the UK, has been the emergence in global capital markets of big economies that have high savings rates, and China is the most significant example of that. And the era of China being integrated into global capital markets, that transition is kind of behind us. And if anything, given demographics and changing levels of wealth in China, one might expect the savings rate to no longer be as high as it has been in the past. So I think to cut to the chase and move into the sort of speculative world of the future, I find it pretty hard to believe that we are going to see something over the next 40 years in the UK, which has been the main driver, I would say, of the increase in house prices relative to incomes over the last 40 years, which is real interest rates just coming down and down and down and down. In fact, there are some reasons to think that they might be, at best, kind of level, and possibly rising. Either way, that would remove arguably the main source of fuel behind the kind of furnace of house prices that the UK has been for 40 years. I'm going to say something a little bit briefer about demographics, where I think that the story is pretty well known, but nonetheless is likely to have a substantial impact on house prices. And of course, the rate at which the what you might call the domestically driven population trends in the UK, which reflect, you know, fertility rates and how many children are born and life expectancy in the UK, is going to be pretty different from most of the last 200 odd years. I mean, this is the crude birth rate in the UK. That is, you take 1,000 population, take 1,000 people. What's the average number of births per 1,000 per year? And of course, it's dramatically lower than it was 150 years ago, or 200 years ago. But it's been falling more recently as well. The average number of children born per woman during the woman's life in the UK is around about, I think, 1.7 now. The rate that would cause the population in the absence of net migration to be constant is a bit above 2. So we're kind of well under that, what you might call the reproduction rate. Interesting to speculate on why that has happened. Absolutely not unique to the UK. It's been true across many, many rich countries. I think largely it reflects good things that have happened, better choices available to women. And it is what it is. And it doesn't look like it's going to go away anytime soon. I was tempted to show you, I'm going to show you a chart, and because somebody might be able to help me, I'm going to show you a chart next, which is definitely one step removed from fertility, and it's about sex. And it appeared twice in the Financial Times, once on the front page and once on an inside page about a couple of weeks later. I've tried to find what is the source of this data. Let me show you the chart. Some of you may have seen this, and since there are many, the majority of you know a lot more about sources of statistics and surveys than I do. I've been trying to find where this data comes from, but I take it moderately seriously because it was in the FT. It's the share of women who say they have not had sex in the past 12 months. And this chart would seem to suggest that it's risen quite a lot, and it's what you might think of as unusually high. But there it is. I make no comment on it. IFOP, I believe, is a French polling firm that's been around for a long time. It's the Institut Français d'Opinion Publique. Who knows who they asked? Anyway. And there's no obvious link between that and fertility for obvious reasons. But anyway, maybe somebody could tell me whether it's complete garbage or not. What kind of survey? Who did they ask? What was the question? I don't know. Does somebody know who IFOP are? Pardon? Badgers. Now, yes, my favourite subject, badger sex. I know where this came from. This is from the United Nations. So look, here's the latest projections. You're kind of familiar with these kind of numbers. But they really do, if there's anything in these numbers, they would suggest that the next 40, 50 years really will be different from the past 50 years. They are projections of where populations will be 50 years from now. The UK actually doesn't dramatically belong in this group, because this is a group of countries I've picked out, or areas where the decline, at least by the UN, of course, this depends on what happens to fertility and net migration. But these are the central estimates, and the falls are pretty remarkable. There's Italy, population close to 60 million now, projected to be 44 million 50 years down the road. South Korea, population 52 million, projected to be 36 million 50 years down the road. Europe as a whole, 745 million, goes down to about 650 million. There are some very big declines here. Where the UK comes on this, on these kind of UN projections is a bit more neutral, in the sense that the population projection, I think, is not very different 2070 to now. But that would be in itself very different, and that turned out to be right. would itself be very different from the last 40, 50 years when there's been, of course, a very substantial rise in the UK population. So, next 40, 50 years, population growth likely to be much lower in the UK than it's been historically, possibly even a flat to falling population. Real interest rates, I would feel fairly confident, unlikely to do what they've done over the last 40 or 50 years. And finally, a change which is much more recent, which is, and I think unexpected, which was the substantial increase in the opportunities, the options many people will have to work from home and not go into the place of work 5 days a week. And I want to spend maybe no more than 5 or 6 minutes just thinking a little bit about what that might mean and describe to you the results of a bit of analysis that I've done with my colleague James Sefton at Imperial College, which does the following. It says if you're trying to understand the pattern of relative house prices across the UK, not so much over time, but just at a point in time, where obviously there are huge differences from being, right in the centre of a big city to being 20, 30 miles away. Certainly that's true in London, on average anyway. You get this house price gradient, that the further you move from the centre where many of the jobs are, and commuting times become greater, then house prices tend to drop off. An equilibrium in the market can be thought of, in a sense, as people making a decision about a trade-off between being close to the centre and not spending money and, more importantly, in some ways, time commuting in to work. So the saving you get is, of course, in terms of comfort, save time, less travel expenses being close to the centre, versus house prices just being on average much more expensive close to the centre. So live in a smaller place, smaller garden, maybe no garden, but you don't spend lots of time commuting, or live 40 miles out and have a much bigger amount of space and less time commuting. And what Sefton and I have tried to do is to take that model, which is a well-known model in sort of spatial and urban development, and graft onto it what might happen if there's a sudden change in the costs of living further away from the centre. A sudden change which arises because for many people where it had been the case that you come into your place of work, the office, whatever it is, or the shop, 5 days a week, and now suddenly you got an option 2 days a week you can work from home. And pretty clearly for people who suddenly get that option, it does change the economics of location. In a way that's pretty obvious. It makes it more attractive to live further away because the time and commuting costs are that much lower, and somewhat less attractive to live near the centre. One thing that seems to be true, though, is that the extent to which this flexibility, these options to work from home arise, is absolutely not equal. In fact, there's a lot of evidence, both in the UK and in other countries, that on the whole, people who earn more have got greater options about working from home than people that earn less. And if you think about occupations where there's virtually no opportunity to work from home, people like nurses, the cleaners, people who work in hospitality, in bars, in restaurants, no opportunity to work from home, and on average those salaries tend to be a bit lower. And if you take the example of people who really can work from home, an investment banker probably can work from home 2 days a week, and a lot of them do, and most people that have more opportunities to work from home, on average anyway, seem to have higher incomes. So what James Sefton and I have tried to do is in a kind of model of equilibrium in the economy, try and assess what happens when suddenly, in a relatively short period of time, there is an expansion in the options to work from home, but it accrues primarily to people on above average incomes. And I just want to show you a few pictures about what comes out of a simulation model that tries to assess the effects of that. This is something that, if you've an interest, again, this is a paper on my website, It's a CEPR discussion paper that came out a couple of weeks ago about work from home and location and house prices. So I'm going to show you a bunch of pictures, and let me just tell you what the pictures are about. These pictures show, in a simulation model that we've tried to calibrate so it reflects what we think is plausibly conditions in the UK in terms of commuting and the relationship between distance and house price before change, and then suddenly you say, what happens if there's suddenly a change? And you go from a world in which everybody had to go to the place of work, which typically are in the centre of cities, 5 days a week, to half the population, and it's the half that got above average earnings, can work from home 2 days a week, 2 out of 5. So it's, in a sense, it's like a 40% reduction in commuting costs. So, a few pictures. And am I okay for another five minutes? Okay. Okay, so what these pictures are, along the horizontal axis, we've got the distance between the centre and the edge of urban development just before you get this sudden unanticipated change in ability of some people to work from home. So 1 on the picture, 1 is to the edge of the sort of fringe of urban development and where the people live when the jobs are nearly all in the centre. That's what 1 means. And beyond 1 is areas where virtually nobody lived before the change. And what this left panel says is what might happen to land prices if suddenly you get this change in work from home opportunities that accrues only to the 50% of the population that have above average earnings. And for what it's worth, the model says that there's going to be a pretty substantial decline in the price of land in the areas where most people were living before the change, but at the periphery, where land was worth something, actually it goes up in value a little bit, which is hardly surprising. If there were places where it was just not feasible for most people to live, and they become much more feasible, so the value of land goes up. House prices, the story is a bit different, but of course less substantial, because a house is worth, what is a house worth? I mean, you could think of a house as being the combined value of the land plus the structure. The land, of course, doesn't go anywhere, and that's why you get a bigger move in price in the land. The structure, which is reflective of the value of, bricks and glass and wood and all the stuff that you need to build a house, doesn't change very much in equilibrium. So that's why the impact on house prices is much less, about half, in fact, than the impact upon much lower impact on house prices than on land prices. So the house price bit is probably the more interesting bit than the land, maybe. And for what it's worth, these numbers, are pretty chunky. They're like 10%. So near the centre of cities, and indeed out on the urban fringes of cities, there's a fall when you suddenly get an increase in opportunities to work from home for a very large proportion of the population of something like 10%. And one of the things that perhaps looks a bit weird about it is that it looks like, from the model anyway that we've used to do this, the decline in house prices is actually not at its greatest right at the centre, but it's a bit further out. There's a kind of suburban edge, the previous suburban edge, where house prices fall even more than in the centre. What's happening in the model, and I don't know whether this is reflective of what might happen in the world, is that we've assumed that half the population has no opportunity to work from home. And because house prices and land prices then fall nearer the centre, if you can't work from home, you at least get the benefit of being able to afford something nearer the centre and reducing your commuting costs, even if you just have to go into work 5 days a week. this is simplistic. We've assumed that the jobs always stay in the centre, and that's clearly not true for some jobs that will move to where more people live. But assuming just that's second order, we're kind of assuming that if the jobs stay where they are, those that can work from home a couple of days a week are likely to find it more attractive to move further out. That's kind of blindingly obvious. Those that can't at least get an indirect benefit from being able to move a bit nearer in, save time and travel costs, and they're able to do that because prices have fallen a bit. So slightly counterintuitively, we find that there isn't much of a change in the density of population in the centre, but it becomes twisted toward having more people living near the centre who don't have the opportunities to work from home. But overall, house prices and land prices would appear to fall by meaningful amounts. There's a few more calculations here. This is. Let me just finish this work from home speculative set of thoughts with this picture, which is this is the impact upon welfare, lifetime utility, if you will, from this change. And forget about the short-term effect for a minute, which has a technical reason which is a bit unrealistic. But the basic story is that those who can work from home, not surprisingly, are better off. You didn't really need an economic model to tell you that. If you increase the options to work from home without forcing people to do it, then how could they be worse off? Well, they're better off to some extent. Turns out that with this 40% reduction, in a sense, in commuting costs, you can work from home 2 days a week. The increase in welfare, if you like, is about 3.5%. That's not trivial. It actually matches something that comes out of a survey that's done of a large sample of people in the US, which asked people, how much would you value the opportunity for 2 days a week to work from home if you could? And in terms of what's it worth in terms of in terms of pay. In other words, if your employer said to you, good news, you can work 2 days a week from home if you want to, and we're going to cut your wages, how much of a cut in wages would leave you indifferent? And the answer was, on average, about 5%. Now, wages and welfare are not quite the same thing, but they're kind of comparable units in a sense. So we're finding like 3.5% increase in welfare, holding wages constant, for those people that can work from home. In some ways, the more interesting calculation is that the people that can't work from home, I've called them office workers, that's not a very good description, but people who have to go into the office every day, right? They gain a bit as well, but not as much, and their gain is natural in a sense, because if it's true that house prices, particularly close-ish to the centre, are lower, then you get an indirect benefit as somebody who can then afford to be a bit close to the centre and have fewer costs of travel in time and rail fares or whatever. So let me just conclude and jump on a little bit. The next 40 years relative to the past 40 years. I suspect the UK population will not grow as much as the last 40 years. It may well be flat. I do not think real interest rates will do what they've done over the last 40 years, which is, as I've said many times, fall by this really very substantial amount. Maybe they'll be flat, maybe they'll even increase. But that would be very different from what I think has been the major driver in many ways of house prices rising relative to people's incomes. Work from home for substantial parts of the week, I think, will be a reality. I think it already is a reality for many people. And it may be the reality for much of their working lives. And that hasn't been true for the last 40 years. And it's becoming true quite quickly. And it seems to me likely to persist. I think all those factors point in the same direction. that the forces driving up house prices relative to the price of other things, relative to people's incomes, those forces driving them up are going to be much weaker, I suspect, in the next 40 years than they have been in the past 40 years. And it may be that, you know, this unusual age of massive rises in house prices may be nearing an end. So on that highly speculative thought, let me stop. Shall I stay up here? Oh, okay.
So there's now an opportunity. Thank you, David. So there's now an opportunity for 10 or 15 minutes of questions, and we'll gather a number and put them to David, and then we'll have another round. I'm going to take chair's privilege and just say, well, we're here at an economic measurement conference, so I'd be really interested to know, where do we measure variables well to make these calculations, and where do we need improvement? So that be the first question. And then I noticed there was somebody with a hand up right in the middle here, so and then over to you. Yeah.
Thank you, Bernard Casey. I'm going to ask you one thing which you raised when you were discussing drivers of interest rates, and you mentioned defined benefit pension obligations, which is something I'm very fond of. It is true that defined benefit pensions are in decline, but they've got a long trail out, which you sort of admitted. But the thing which has been growing, on the other hand, is defined contribution pensions, which are going to have to be possibly annuitized at some stage. The amounts concerned might be smaller than with defined benefit pensions, but the actual volume of people doing this is also going to grow. So I wondered whether you could comment upon whether that influences what you do. I wondered also whether you could comment upon the fact that although there might be fewer people, more of them want to be living singly. So that pushes up numbers, even if the numbers of people stay relatively constant. Thank you.
And Arthur Torrell is the next.
Thank you for a fantastic talk, David. So probably speaking for some of the younger people in the audience here, which I don't necessarily include myself in, but I was wondering if you think that birth rates might be endogenous to house prices. I certainly know lots of friends for whom that's true. Thanks.
Okay. One more from Leonard, who's just next door, and then we'll let David respond to those and gather another set.
So I was thinking about the demand from housing from tourists, of which I am one right now, sort of, and from students, and how both of those might be affected by Brexit.
Okay, David, do you want to take those 3 or 4 questions?
Yeah,
first?
sure. On pensions, yes, I think absolutely you're right that, you know, as DB outstanding pension claims liabilities kind of trail off, which is almost inevitable. I mean, I don't think DB pension schemes will reopen. Companies are not going to reopen them, and it's just one-way traffic in terms of where they go. And DC will probably do the opposite. I think that's absolutely right. Whether or not there'll be the same demand for the rising DC pension pots as the declining DB pension pots for longer dated gilts, either conventional gilts or inflation-proof gilts, is an interesting question. I kind of slightly doubt it myself for the following reason. Firstly, I mean, you'll know this better than me. Firstly, I mean, people don't have to annuitize. And indeed, there are many reasons not to annuitize. So, you know, getting to 60 or 65, whenever it is you choose to retire, you've got a pension pot. If you annuitize, you are in a sense, well, you're doing many things. I mean, the first thing you're doing is removing the ability of your kids to benefit from your dying soon. And if you don't annuitize and just leave a pension pot, and have the flexibility to run it down as you wish, which now exists, didn't used to, then added to that the kind of favourable treatment at the moment anyway of bequests of pension assets in terms of being exempt from inheritance tax, all of this adds to making annuitisation, I think, actually quite unattractive for a lot of people. Now, of course, that could change. I mean, if real interest rates were extremely high, I mean, they're still not. You know, in 10, 15-year index bond yields, real interest rates on index-linked bond yields, to which annuity rates are pretty tightly linked in some ways, are still historically really low. I mean, they're barely positive in the UK, but plus 0.5%. So although annuities are much more attractive than they were when those real interest rates were minus 2.5, they still don't look fantastic. And you know, you could find people who've got what they think of as a very large pension pot, several £100,000, and then they see what annuity they get, and they think, wow, you know, is it that low? And allied with the lack of flexibility, my guess is that annuitisation will be kind of pretty limited, actually. But we'll see. Birth rates endogenous to house prices. I just think there's definitely something in that idea. The more expensive it is to move from the house with 1 bedroom to a house with 2 bedrooms, or then 3 bedrooms, then you think about, well, you know, do we want the second child? Do we want the first child? We probably don't want 3 children. You know, it's a factor. I think it's probably not top of the list. Who am I to say what has made the decision of women to have fewer children than their parents and grandparents, and certainly great-grandparents? I don't know. I suspect part of it is greater opportunities to do other things in life and spend a lot of your time childbearing and looking after young children, a lot of young children. Those opportunities weren't there as much even 50 years ago. They certainly weren't there 100 years ago, and my goodness, they weren't there 200 years ago. And my guess is that is the bigger factor over the long sweep of fertility rates going from 4 to 3 to 2 to 1.7 or wherever we are right now. But I certainly don't dismiss the idea that house prices have got something to do with the decisions. Student and tourists who require places to stay when they're in the UK and the impact of Brexit. Again, I think there's something in that. On the student thing, there's a two-way pull in a sense. It may be more tricky. I was going to say it may be more tricky for people from overseas to come and study in the UK. Actually, if you look at the visa data and the number of visas granted to people to come and study in the UK, that doesn't seem to be a big obstacle at the moment. And furthermore, universities, I'm sure this is true of King's as well as it is of Imperial and most British universities, have a very substantial incentive to get a lot of overseas students, because you can charge overseas students, if they're undergraduates, what you like, and you can't do that for UK students. And there is a much bigger demand for what are relatively expensive one-year taught MSc programs, graduate students, a much bigger demand from overseas students than there are from British students. And so the pull factor from UK universities to attract overseas students is very, very strong. And you know, if you just look at the numbers, some of you I'm sure will be fully aware of this. If you look at the numbers of not just of overseas students in aggregate, but also the switch between undergraduates and graduates in British universities over the last few decades, it's been really very substantial. And that is all to do with money. So, does Brexit mean that we're going to get fewer students, fewer people want to come to the UK as tourists? I rather doubt it, actually. I mean, it's a government decision. You know, the government may be about to make an announcement about student visas and when you are and are not allowed to bring dependents from outside the UK. Who knows? We'll see. On the data question, I think in many ways we're very lucky, not just in the UK but in a lot of countries, to have extraordinarily rich data on housing markets. And some of that is like, you know, official data, ONS data, which is very good and goes back a long way and is careful in doing what you might call hedonic price adjustments. So the mix of houses that are actually sold changes from, you know, month to month. And you need to do the sort of hedonic price adjustments. Last month you may have sold an unusually large number of small one-bedroom apartments, so you can't just take the average price of that and compare it with the price 6 months earlier when there were more, you know, between the walls semis with 3 bedrooms sold. So, you know, we got nice, you know, quite sophisticated models of doing that kind of adjustment. But what we've also got are, I mean, now enormous databases, you know, from the likes of Zoopla and others about all the transactions in a particular area very recently, not just on house prices, but on rents and things like that. So I think we're very lucky actually in housing research on having such good data.
So we have time for just a few more questions. Joe Grice has his hand up, and Kevin Fox.
Thank you very much, David. It was a very nice talk, a very nice narrative as well. But there's one thing that slightly puzzled me. Going right back to your first slide, the one that shows how UK house prices have risen more than in most other countries. That's the overall impression, but looking at it a bit further, it seems to suggest it was very period specific. And that actually, since about 2005, there hadn't been any increase in real house prices in the UK. All of the actions taking place in the years before that. But that then leaves me wondering, well, if all this analysis is designed to explain why house prices have risen in the UK, on that data, the suggestion would be that they haven't risen, at least over the last 15 years. So I was wondering how that fitted together. And actually, in terms of the bottom line, your last slide, if that data is taken at face value, you could argue, well, the age of massive rise in real house prices is not nearing an end, it actually ended 15 years ago. But there's a puzzle there for me.
So 2 questions here at the very front.
We also
Kevin
have
and
an
Jonathan.
online question, Paul.
Okay.
Kevin Fox from UNSW Sydney and ESCoE. Very interesting talk. I've got a question, well, just a point to start off with about user cost of capital. It's a measurement conference, so I should just note this. You did say that land, or the price of a property is a combination of land and structure, yet in your user cost of capital formula, you seem to apply the same depreciation rate to both the structure and the land. I know it's common in the literature, but just thought I'd note that that's not quite right. But there's another part of the user cost formula, and that's the expected capital gains. You did discuss a bit about supply response, but when I think of the countries, the other countries or the other places in the world that have experienced very rapid property price increases, that Auckland, New Zealand, Sydney, Australia, Vancouver, Canada, supply is clearly a major problem. There are local, while we think that housing affordability at the national level is a big policy issue that we can all agree on, it's really, supply is a local issue, and locally no one wants their house to become affordable. It's a store of wealth, and that's what's happening. People are voting for political parties that will ensure that they keep their wealth. They will talk about the difficulties of housing affordability, but they will make sure that development doesn't happen in their neighbourhood. So I think a lot of what's been going on is the supply constraint, that supply is not very flexible.
Jonathan, do you want to? ask your question.
Yeah, thanks, Paul. Thanks very much, David. Jonathan Haskell. Really interesting lecture. David, you talked about working from home. I wonder if you could say something about living at home, by which I mean for many kids who perhaps in the past moved away and bought their own house, for them living at home is a sort of margin of adjustment, as it were, which might be open to them, and that might be a rational response to how higher house prices. And I just wonder whether that's a big factor and whether that should kind of factor into the thinking that you've been talking about. Thanks.
And finally, there's one question online, which is about the trade-off between buying a house versus renting and then using the resources to buy another asset and get the real returns from that. To what extent is there any evidence that people actually exploit that trade-off?
Very good. Lots of good questions. Gosh, tricky ones, actually. Joe, you're right, of course, that 1985 to 2005 saw a disproportionate amount of the overall price increases. And 2005 to more or less now has seen much less of a rise, much less, or maybe not much at all, yeah. I think one of the factors there, I mean, the timing doesn't exactly work, but I mean, the financial crisis kind of begins 2007 with Northern Rock. It obviously becomes very serious in the autumn of 2008. Then there's a real change in the availability, certainly of high loan-to-value ratio mortgages. And that doesn't really get accounted for particularly well in the model, which is a model with no quantity restrictions in a way about the affordability of finance. So I'm taking something which is clearly not realistic. In other words, the model that generates this big increase consistently in house prices sort of says, well, if you know what the real interest rate is on index-linked bonds, you just add a bit, and that's the cost of a mortgage. But that isn't really quite what happened, because 2007, and then for the next several years after that, suddenly certain kinds of mortgages at any price are not available, and there aren't 100% loan-to-value ratio mortgages. They're just coming back in, I think, in the UK. We'll see where that goes. But there's that step change in availability of finance, which in the simple model kind of gets ignored. And I think it's pretty substantial. I mean, it clearly mattered in 2008, 2009, when real house prices fell a lot in the UK, even though index-linked bond yields, which I've put at the heart of the story about why house prices go up, also fell a lot, because it looked like the economy was descending into a black hole, and quite often that's good for very safe assets. And so that particular period is not well explained by this model. So you're right to point that out, and we need to do something a bit more complicated, which had both a fall in the safe real rate, but potentially a simultaneous rise in the shadow cost of raising money in the mortgage market, particularly for people who are first-time buyers. So we kind of, it's too simple a model to deal with that, but it mattered, I'm sure. Yes, absolutely right. Of course, land doesn't depreciate, or at least much, but the structure of the house does, and we've simplified by just assuming that everything gets worse by 1%, and you have to spend some money and putting it right again, and that's not quite right for sure. I very much agree with what you say, that you put it very nicely, that nobody, once they bought a house, nobody wants housing to become more affordable in their area, you know, unless you're very benevolent to other people, or you've got a load of kids and the kids want to live there. But most people, you know, they don't want any more houses built near them. And that's absolutely a factor that's been at play in the UK, and not just the UK, but in a lot of countries. And it's hard to see that easily going away. So it's more or less a constant, really. It's kind of reflected in the simulations and because it's reflected in the data, about being a very low price elasticity of supply of housing. And I mean, were that not the case, then a lot of what I said would just go out the window. So I mean, suppose you go to the opposite extreme, and maybe there are some bits of the world which are like this, the other end of the extreme being, if there's more demand for housing, you just build more houses. So, you know, there are some American cities, you know, Houston may be one, where you've got this kind of enormous flat plain of land, and if demand rises by, you know, 1 million in 5 years, you build 1 million more houses, and they're just a little bit further from the centre, and the land's there, and the transport probably is quite good into the south. I don't know Houston that well. But you don't do that in Manhattan, you don't do that in San Francisco. So you're right, you're absolutely right. I mean, it is central, because, I mean, had there been a decline in real interest rates and a decline in the, in some sense, cost of acquiring housing, and the demand for housing had gone up, but the supply was completely elastic, there was always more land, you could always get bricks and cement and glass at the same world price, then what would have happened in the UK is no increase in real house prices and just loads more houses. And we're at the other end of the extreme, not many more houses and a big increase in real house prices. Living at home and children, yes. Well, I think, again, there's something in that. Certainly with jobs where you only need to go into the office. I mean, for some people, it's you need to go into the office 3 days a week and work from home from 2. For some, it's, you know, it's 4 days at home and 1 day in the office. And for some, it's we haven't got an office anymore. You know, you've got a job. One of my kids, her first job was working, you know, for a magazine which had decided during COVID to save money by not having an office. So there was no office for her to go into. It's absolutely miserable. And this is a complete aside about housing. You know, working from home as your first job and not really meeting your colleagues, it's just a terrible effect on people's development and mental health. Anyway, I digress. But yes, I'm sure it is a factor that at least it's an option in a way that it would, you know, might not have been historically, to live, you know, 50, 100, 200, 400 miles from where the notional location of your employer is. Finally, just 1 minute. I mean, but buying versus renting and the attractiveness of all that. I think one of the things that has happened in the UK, I think you're seeing it, and it shows up in cities across the UK where renting has become really more expensive and more difficult to find rental property, is another driver of the desire of people to be landlords, and particularly small-scale landlords where you might own 1 or 2 rental properties, the buy-to-let market and all that. And I think life has become substantially more difficult, less attractive for that, partly because of the tax system, which for unincorporated landlords, and most kind of small buy-to-let landlords were not incorporated, but they used to be able to deduct interest payments, I think I've got this right, interest payments at whatever their marginal income tax rate was, and that's no longer true, plus measures that are increasingly coming into force, which are controversial, I mean, and could be described as entirely benevolent, protecting the rights of tenants from being evicted at short notice, but could also be described as substantially reducing the flexibility and the options available to landlords to decide to not become a landlord and to go back and occupy a house that they otherwise were renting out. Whichever way you look at it, I suspect that there is a bit of a squeeze on the supply of property for rent in the UK, particularly from small landlords, and that is not unrelated to a real, what I think is a substantial increase in the difficulty in many cities of people finding rental property.
Well, David, you started the lecture saying you didn't need to introduce the topic, its importance and also interest, and I think the number of questions we've had and the number of avenues of inquiry that spin off from your central topic indicates that that's the case. So thank you very much for an excellent lecture, and we'll thank you in the usual way.
Thank you.